Scotland's first crypto hedge fund. I used to be a TradFi investor for nearly 10 years. I started at Baillie Gifford, which you would know as being a prolific Web2 investor. They've of course capitalized on what feels like forever kind of incumbent domination of tech giants, but of course now we're in the Web3 realm. And there's actually not too many people, I would argue, who are thinking about crypto investing or liquid token investing in a similar way that a TradFi investor who practices long-term fundamental investing would. So that's really what Progrmd Capital is focused on, bringing some of the economics 101, investing 101 techniques and concepts to really thinking about how to create capital growth for investors in liquid tokens. Just to engage the audience a little bit, who here, when they've bought crypto, has either gone on Token Terminal or Artemis or any of on-chain analytics data platforms to understand how much of fees or earnings or dividends you'll be entitled to when you're buying a token? Okay, that's, I would say 20%. That's pretty good turnout. Yeah, so the point is, when you're browsing on crypto Twitter and such, it feels like narrative investing really is how a lot of market participants are thinking about investing, but this presentation will be focused more on the economic side of things. So yeah, to delve into the meat of the presentation, so what is token investing? It really is, liquid venture investing in a sense that we're providing capital to nascent, young, internet-native businesses that require capital. And this is very distinct from how TradFi or equity investors kind of invest through the maturity of companies. So, in the traditional VC, you would have pre-seed, seed investors that kind of bootstrap the start of the startup, and then you move through Series A, B, C, and beyond until the company reaches an IPO, which is basically an exit for the venture capital investors. In crypto, we have a completely different situation for capital formation. We basically have token launches way earlier, sometimes even before the minimal viable protocol is reached. So it's really, to frame it, it's early, venture investing, and that's probably why, in many situations, it's really been difficult to focus on the fundamentals because in many cases the products themselves are not available. But we've had crypto be a thing since 2008. So as protocols like Ethereum start to gain users and fees, we're moving into a time where we can start to think about the basic economics when investing in crypto. So you may have come across this categorization. This is by Robert Greer, which was published in 1997, Journal of Portfolio Management. And in this framework, he asks the simple question of what is an asset? And he says capital asset is basically an asset that produces future cash flows. So we'd be used to investing in capital assets through stocks, which give you variable infinite dividends, bonds, which give you predicted finite interest payments, and real estate. If you're an owner of real estate, you get some level of income as you rent it out. So these are capital assets that most investors would have most of their money in their portfolio parked in. Then we also have consumable, transformable assets, so CNT assets. They are assets like commodities or precious metals that don't give you the same level of stream of income, but they still have economic value because they provide some sort of utility. So yeah, oil, gas, any sort of metals they would fall into this category. And finally, we've also got store value assets, SOV assets. They have some value, although they neither have cash flows nor any sort of utility in a way that can be consumed to produce something useful. And, you know, currency, fine art, these are examples where, based on the social consensus of people in society, they come to accrue value. And when put into this framework, crypto is a really interesting asset class because you can basically find all three elements of capital asset, C&T asset, and store of value assets in crypto. And we've never actually had any asset class that satisfies all three. So when people are confused about how to value crypto, it's probably exactly because of this. You have so many different ways of seeing crypto's future cash flows, its utility in a protocol, as well as how people think about what it's worth and whether it's worth putting some of their savings into. So I want to talk about Ethereum's economic model and walk through a framework which can be used by, say, TradFi investors to really understand what Ethereum could be worth. So this diagram's a little cramped, but it's just basically a summary of how Ethereum works. So Ethereum is essentially a two-sided platform. On the left side, you've got end users who create demand for transactions on the dApps that are built on top of Ethereum. They pay transaction fees in the form of base fees, which are just uniform across the users, and then tips if the users want to gain some sort of advantage over other users. And then on the right side are the supply side, so the validators who stake their ETH as collateral to provide security to the system, and they, in return for validated transactions, get validator rewards. This also come in two forms. One is a token issuance by the protocol, and the other is just a tip that's passed through from the users. So in this context, if we think that Ethereum is essentially a business that sells block space, could we use any TradFi techniques to understand what will drive Ethereum's or ETH's value? So I want to introduce this notion of three engines of equity value. This is pretty commonly used in TradFi fundamental investing. It's basically this notion that you can decompose future stock price returns into three elements. So you've got earnings growth, how in the future is the earnings of the business going to progress. You've got then PE multiple, that's price to earnings multiple. So that's basically the market or the investor's assessment on the value of the business, how much they're willing to pay for $1 worth of earnings produced by that company. And then the final lever is share count reduction. So we'll go through each element in the context of Ethereum and try and understand how ETH could progress in the future. So first, transaction fees. So you're seeing in the graph how user transaction fees have progressed in the trailing 12 months from 2019 to 2022. So we didn't really have much in the way of user transaction fees way back then, and then it really started ramping up in 2021. Of course, this is in dollars, so as Ethereum's price goes up, you'll see the dollar amount also go up. So there's some reflexivity baked into this mechanism. But basically, transaction fees on a 12-month trailing basis grew from 35 million in 2019 to 4.3 billion in 2022. And we're tracking around 4 billion on an annualized basis based on the last 30 days. So that's 124x in the Ethereum's earnings growth. Next is price to earnings multiple. So as mentioned, this is basically how much investors are willing to pay for $1 of company's earnings. And the way to understand this intuitively is if the company's earnings stayed the same, how many years would it take for an investor to get their money back? So if PE multiple is 10 and the earnings of the business haven't grown or gone back, then it'll take an investor 10 years to get their money back. So it means that higher PE ratio is often found in companies with higher growth potential. And just to give you some context, if you look at the global stock market, right now, the median global PE is 17 times, with the 25th percentile at 13 times and 75th percentile at 30 times. And in the blue, I've kind of indicated where Web 2 tech companies are trading at. So Amazon is at 100 times, Tesla at 50 times, and Google 25 times. So that gives us a sense of the market's assessment of future earnings potential. Let's look at Ethereum. So from 2019 to 2022, as earnings grew, PE multiple compressed from 410 times to 34 times its transaction fees. So that's a fall of nearly 92%. It's interesting that Ethereum is trading at a lower multiple than say Tesla at 50 times. You can take a view on which has the higher growth prospects, and not biased at all, of course. And the last element, share count reduction. This is just a graphic to really help drive why, the idea of why share count reduction creates value for investors. Let's say you've got a company represented in a circle that's worth $80. If you divide it up into 8 pieces, each piece is worth $10. Let's say the company then buys back or gets rid of 4 shares. So now you're left with the same pie worth 80, but with 4 slices, giving each slice $20 per share. So you can see why owning a share of the same company that's buying back shares, or in crypto terms, burning tokens, would be very useful and value accretive for the investors. Well, Ethereum's token supply is an algorithmic mechanism. You've got the token issuance, which is directly related to how much ETH is staked. So the closed form formula for this is 166.32 times square root of number of ETH staked. On the reduction side, you've got the base transaction fees that are burned. So the net effect of the token issuance and the reduction would basically be the network's inflation or deflation. From 2019 to 2022, this is pre-merge, so there was a lot more dilution on the token supply side of things, but we basically had token supply go from 108 to 122 million, which is a 13% increase. Right now, you can see the clip or the extraction from ultrasound money. The blue line is where we're tracking. So with the recent meme coin craze, we've actually had higher revenues or transaction fees to the protocol, and we're tracking to burn around 1% on an annualized basis. So, putting the 3 elements together, how has Ethereum progressed from 2019 to 2022? We've had an earnings growth of 124 times, combined with a multiple compression of 92%, and a share count reduction of, share count growth of 13%. So you multiply the 3 together, and you get the, it says stock price, but an ETH price return of nearly 9, or just over 9 times, from 130 to 1180. So I've just demonstrated, TradFi investors' understanding of how to express Ethereum's, value accrual from a purely economic point of view. You can take this framework to really try and model what ETH will do in the future. So you can ask the questions like, what is the big opportunity? How big is the opportunity for transaction fees? What do you think is the market going to be valuing $1 earnings or fees of the Ethereum protocol? And is ETH likely to be inflationary or deflationary? And answering those questions or having some sort of model in your head can help you understand where Ethereum or ETH as a capital asset could go, and that should provide more of an anchor, I believe, to investors, both TradFi and crypto native, to gain some understanding and comfort of whether it's a sell, buy, or hold. So that's all I have for today, and happy to take any questions. Yeah?